Hello there, Prof. Aram here, and in this video I'm going to go over the concept of efficient market hypothesis and how efficient are our capital markets. So let's get to this. As we saw from the market history data, stock prices fluctuate quite a bit from year to year or from day to day. So why does this happen? Why do we see these fluctuations in the stock prices? This happens partly because new information comes in and investors react to the new information and reassess the value of these assets given the new information that they have regarding those assets. One of the most important questions in finance is whether prices react to new information quickly and correctly. And a market is said to be efficient if this is the case. If the information is analyzed quickly and the stock price or asset prices are reflecting those new information quite fast. In other words, in an efficient market, current prices fully reflect the available information, which means that based on available information, there is no reason to believe that the current prices are too high or too low. So stock prices are fairly priced in this efficient capital market. And if this is true, if the stock prices are fairly priced, then you should not be able to earn abnormal or excess returns. This doesn't mean that you're not going to earn any return. It just means that you cannot earn abnormal return. You're still going to earn your expected rate of return. The reaction of stock prices to new information in efficient and inefficient markets is depicted in this graph. If at time 0, new information comes in about an asset, in an efficient market, the new information is reflected immediately. You see the immediate impact on the prices of that asset. If the market is inefficient, you're going to have a delayed reaction. It takes a few days for the market to react to the information. And sometimes you can have overreaction to a news and then a correction after that. So in this case, investors overreact and the stock price goes up to 220, but after a while, after a few days, you'll see a correction of that movement and the price would be the same as what the efficient market suggests to be at that point in time. The reason that markets are efficient is that there are a lot of people out there, investors and financial analysts, that are researching these stocks and other financial assets. As new information comes to market, this information is analyzed and trades are made based on the new information. And because of that, prices should reflect all available public information. If investors stop researching the stocks, then the markets will not be efficient. And just keep in mind that not all available information is reliable. It is still important for you to do the research and not just jump on everything that comes across your news wire. In terms of the efficient market hypothesis, we have 3 forms of efficiency. One is the weak form efficient market, in which the information that you have are past prices and volume data. So basically everything that happened in the past is available to you. Because of that, technical analysis is of little use. And then the other one is the semi-strong form efficient market, in which you have access to all those historical information plus some publicly available information that's distributed by the company. In this case, fundamental analysis is of little use. You cannot earn abnormal returns with this fundamental analysis that you do. And then the last one is the strong form efficient market, in which that investors have access to both private and public information. In other words, there is no information asymmetry between the investors and the management of the company. You have access to the same type of information. So in the weak form efficient market, prices reflect all the past market information, such as price and volume. And if the market is weak form efficient, investors cannot earn abnormal returns by trading on market information. It implies that technical analysis would not lead to abnormal returns over time. And one day you might have some returns, but if you keep doing this for an extended period of time, you're not going to be able to consistently earn abnormal rate of return. And empirical evidence indicates that markets are generally weak form efficient. So when we emphasize that just because technical analysis shouldn't lead to abnormal returns, that doesn't mean that you won't earn a fair return using it. Efficient markets imply that you will, but you will not earn abnormal returns. So this is the key point here. I also want to point out that there are many technical rules that have never been empirically tested. So it is possible that one of them might lead to abnormal returns, but if it's a well-publicized technical rule, it is very unlikely for you to use it and earn abnormal returns from that. The other form of efficiency is the semi-strong form of efficiency, where you have access to all the historical data plus the publicly available information, including the trading information, annual reports, press releases by the company, and so on and so forth. If the market is semi-strong form efficient, investors cannot earn abnormal returns, right, by trading on public information, which implies that, of course, fundamental analysis will not lead to abnormal returns. Again, empirical evidence suggests that some stocks are semi-strong form efficient, but not all. Larger, more closely followed stocks are more likely to be semi-strong form efficient compared to some smaller micro-cap stocks that are traded over the counter. Small, more thinly traded stocks may not be semi-strong form efficient, but liquidity costs may wipe out any abnormal return that you earn from those micro-cap investments. And finally, we have a strong form of efficiency in which you have access to all private and public information. If the market is strong form efficient, you cannot earn abnormal returns regardless of the type of information that you possess. And the empirical evidence shows that the markets are not strong form efficient, simply because we do not have access to all the information regarding an asset, regarding a company. Usually the insiders of the company have access to better information, private information that we do not have as outsiders. So because of that, markets are not considered a strong form efficient. So in the US, most of the stock market and bond market, they're considered semi-strong form efficient compared to a strong form efficient. I hope you find this video useful, and thanks for watching.